Nearly every time I see this setup on a chart, I take it. And the reason is that the setup I'm going to share with you today is one of the most accurate ways I have ever found to spot when prices are likely to reverse in any market. So in this video, I'm going to share with you a live trade we had using this exact setup, and I'm going to share every rule that I use when spotting these setups. That way, you'll have a brand new reversal trading strategy. You can decide whether or not you want to add to your trading arsenal. So if that sounds good and you're ready to learn a simple but effective reversal strategy, go ahead and click that like button for me. Go ahead and subscribe if you are new, and I'll be right back after the intro and disclaimer. Welcome back, and let's go ahead and get started with looking at this setup itself. We're on the pound Swiss here. This is a live trade we had, so I'm going to walk you through this trade. Let's start off with the preemptive analysis I did, which was looking left to spot a major level of structure. As you can see here, we have this major level of support that I was looking at as support yet again, but we've already been supported. So let's pretend price is exactly where I have the market replay tool, right? At this point, I wouldn't be sure if I wanted to trade because we've already made a move up from the support level, and this move, in fact, made a lower high before pushing down and retesting it. So what I'm looking for and waiting on in this specific situation is I'm waiting for added confirmation. The added confirmation here is going to be a break and close above this previous level of resistance. If prices have bounced off of this support level now twice, and we can push high enough to break and close above the previous high, then I see this as being a strong enough market for a possible reversal. And we're going to break this down with CEST, conditions, entries, stops, and targets in just a second. But I want to talk you through the mindset first before we look at the technical rules for this exact setup. And this was the mindset. We have lower highs coming in while prices are bouncing off of the same support level. So I'm not interested in trying to capture a buy trade from here because we could very well see something like this in a continuation down. For that reason, I want some added confirmation of waiting for this level of resistance to be broken before I decide, okay, we could see this reversal and we could see prices continue to head higher. So that's what I'm waiting for at this point, and that's what I was thinking preemptively before placing this exact trade. Let's push prices forward. As you can see, just one candle later, we do in fact break and close above this level. Now at this point, for this reversal setup and this reversal strategy you're learning today, at this point, I'm waiting for a pullback and a candlestick pattern. We'll break that down a little more when we go through the CEST, the full strategy rules for this, but just know that that's what I'm waiting for at this point. And as you can see, if we continue pushing forward here, we end up getting exactly that. We get the push up from our support level, the break and close above the previous level of resistance, a pullback, and a nice engulfing candle right here. Now for me, that was enough to enter the trade. I ended up getting involved a couple of candles later when I actually saw this trade. And what I'm going to do now is play you a clip from me exiting this trade live. So here we are back on the pound Swiss. As you can see right here is where I exited this trade. And that was for about a 2-to-1 reward to risk ratio. So now let's break this down using CEST. As I stated before, this stands for conditions, the entry you're going to use, the stop loss you're going to use, and the target you're going to use. For veterans of the channel, you've heard me say this about 1,000 times, but if you're new here to the trading channel, anytime you place a trade, you need to have set rules for each of these. You need to understand and know the conditions you are using. Were you using supply and demand? Were you using support and resistance? Were you using a specific indicator? What were your rules? Did we need to be above a moving average? Did we need to pull back to a previous level of resistance? All of that would be examples of conditions. You need to know exactly where you're going to be entering the trade. Why did you press the buy button? Was it because of something like this engulfing candle? For me, that was my reasoning. That was my actual entry. And you always want to know where you're getting out if you're wrong and where you're going to get out if you're right on the trade. That's known as stops and targets. So let's break this trade down and break down this entire strategy using CEST. So first off, I need to see prices break above a previous level of resistance in a reversal manner. What I mean by that is prices need to have been pushing lower, making new lower highs and lower lows, And then I need to see prices break above a level of resistance. So when I say a reversing manner, I mean we need to previously have been in a downtrend before prices break above this level of resistance. That's my initial step. The initial step is to look for price action to tell me we have a possible reversal. And that telltale sign is when prices break above a previous level of resistance. Now, the next rule we're going to be using is to do with an indicator. We're going to need the 50 EMA on our charts. And the reason for having this 50 EMA on the chart is that the second rule is for our pullback after the break above a previous resistance level in a reversing manner, the pullback cannot close below the 50 EMA. So in this case over here, we actually got a very similar situation where we have prices pushing up and we have a break above a previous resistance level. This would be a very good reversal setup as well. We have prices pushing down previously. We have a break above a previous resistance. This is what I call a 1, 2, 3 move, signifying a possible reversal. But then the pullback here closes below the 50 EMA, negating our ability to place a trade based on the second rule we have, which is our pullback cannot close below the 50 EMA. If we do, in fact, close below that 50 EMA, I'm no longer seeing this as a possible reversal. I'm seeing this as possible continuation to the downside, and I don't want to press the buy button until that changes. And so, in this case, we have prices pushing up and finally breaking and closing above a resistance level. Our rule number 2, we have a pullback. We want to see at least a couple of candles pulling back, and we don't want that pullback to hit, or not to hit, to close below. We can touch it, but we don't want it to close below the 50 EMA. So that is our conditions. Now the C in our CEST, the way we build and use strategies, the C is checked off. We have prices pushing up, breaking a resistance level. We have the pullback not closing below the 50 EMA. Conditions are met, right? Next up, you need to know why you're actually pressing the button. As I said, for me, it's that candlestick pattern. It's the engulfing pattern here. And when I say candlestick pattern, just pick one. There's like hundreds of candlestick patterns. My favorite two are engulfing and shooting star and hammer bars. So those are the ones that I tend to use most. Pick ones that you find work best for you. For me, it's going to be this engulfing bar. So now my entry is met. When that bar closes, that's when I want to be placing my trade. So I have a set in stone rule for my entry. For my stop, I took a 1 ATR below this previous low as my stop loss. And for my target, as you can see, I ended up getting out at about a 2-to-1 reward to risk ratio. But having rules for each of these, CEST, is how we build strategies that are rules-based enough for us to stay consistent to and that we can use to pull profits out of the market. So if you get nothing else out of this video, please remember that anytime you place a trade, it needs to follow a strategy or system that does include all of these: your conditions for entry, your actual entry reason, your stop loss, and your target before you ever press the buy or sell button. Here we are still on the pound Swiss. We're gonna take a look at a bearish example of this setup. What do you see right now? What has price just done? From our preemptive analysis, we can see that prices were in fact trending up. We're staying above the 50 EMA. We're putting in higher highs and higher lows. But what has changed now that we are where price is? That was a weird sentence, bear with me. Now that we are here where price is currently, the thing that has changed is we've no longer put in higher highs and we've actually put in what? A lower low. This is our first rule for the strategy in the bearish direction, is we want to see prices create a new lower low while previously having been in an uptrend. So previously we were in this uptrend. Now we've made a new lower low, meeting condition number 1. What's condition number 2? We want to see a pullback that does not touch the 50 EMA, which is our blue line on the chart. So we're going to push the market forward just a bit here. We have our pullback pushing up. Have we touched the 50 EMA? No, not yet. So as long as that continues to stay the same, as long as we don't close above the 50 EMA, I think I said touches the last couple of times. I mean to say close above. We can't see it, the market price candles close above the 50 EMA. So as long as that continues to be the case, we will have both our conditions met. Now for a bearish trade, what do you think we're looking for in terms of an entry? We're going to be looking for a bearish engulfing bar for the examples in this video. So the next thing we need to look for, as long as we continue not to close above the 50 EMA with our pullback, is that bearish engulfing bar. Let's take a look at what price does. And there we go. Tell me now, can we enter this trade? Or for example's sake, I'm not telling you how to trade, but if you were trading this strategy, is this a time you would enter this trade? Hopefully you were able to say yes. And the reason is we have all our conditions and our entry reason met. Price has now made a new lower low compared to our previous low since being in an uptrend. So that would be a reversing scenario. We have our 1, 2 being this whole pullback, 3 being the break and close below. We have that move already. Next, what do we want to see? A pullback that does not close above the 50 EMA. Is that happening? Yes, it is. Next, what do we want to see? A candlestick pattern. In this case, it's that bearish engulfing. So now we have C and E checked off. The next thing we want to do is place stops and targets. As I said, for stops, I like to do a 1 ATR stop above or below the swing high. The swing high is right here. The ATR indicator can be found under the indicators tab. It just tells you the average movement of the market based on the last 14 candles. Essentially, it's a little more complicated than that, but essentially that's what I use it for. You can see it right up here in the top left of my screen. As you can see right now, we have about a 44 pip ATR. So I would go up to the swing high and I want to go 1 ATR above that. So I would do 44 pips above that, which is 34 up to our swing high. Plus 44 is going to be 78 pips on that stop loss. I took a 2-to-1 on that previous trade that you saw live, but I normally stick to about a 1.4-to-1 reward to risk ratio for these types of trades. If I click play here, you'll see that the market played around a bit, but eventually did in fact come down enough to hit those targets. All right, those two examples were good, but this is the absolute perfect example I can show you. Check this out. We have prices doing exactly what we need them to. We have a downtrend happening. Then we get what? We get this break above a previous resistance level. Condition 1 and 2 met. Check them off. We're good to go. What are we waiting on now? After conditions, we're waiting on that entry reason, which is going to be an engulfing candle. Let's press play right there. Just absolutely perfect. We're going to go ahead, put on our position tool, measure out stops and targets using the ATR, about a 1.4-to-1 reward to risk ratio. Perfect scenario. Let's hit play. Oh, shit. It was a losing trade. This is going to be the best lesson I can give you in this video. And it's not about a strategy. The thing that separates a professional trader from someone that goes and tries this trading strategy, tries any setup 5 to 20 times, right? The thing that separates the winning trader from the losing trader is that the winning trader knows how to handle losses. So although I showed you 2 winning trades, trust me when I say you will not find a strategy that always wins. And a huge part of you becoming profitable will be your ability to handle losses. That's the only reason I'm sitting here in front of you, is because I am really good at handling losses. Let me explain a little bit about what I mean by that with some math. So with a 1.4-to-1 reward to risk ratio, the exact setup I've shown you throughout this video normally wins between about 50 and 60% accurate for me. So with that being the case, that means I have to be able to handle 40 to 50 losing trades throughout a 100 trade sample size if I want to see this setup be profitable. Think about that. Think about having to withstand 40 to 50 losses out of every 100 trades you place. Well, that's what professional trading is. You're not going to find the miracle strategy that wins 90% of the time with a 3-to-1 reward to risk ratio. Your edge is going to be a very minute edge. This is the same way casinos work. Casinos just have a very small edge over the player that they take advantage of a ton of times. So eventually they come out extremely profitable. We're doing the same thing in trading. We have a slight advantage based on a rules-based strategy, and we exploit that advantage as many times as we can in order to come away profitable over a long period of time. So breaking the math down, as I said, if we go through 100 trades, let's say I win 50 of them on the low end, and I have that 1.4-to-1 reward to risk ratio, that means I have 70 as my wins, and I lose the other 50 trades out of 100. That gives me what's called 20R. 20R means I'm going to make 20 times whatever I'm risking. So let's say I'm doing my normal thing and risking somewhere around 2% per trade. That means out of every 100 trades, I'm going to make around 40%. And the only problem with most traders is not that they have not found a profitable strategy. It's that their emotions, their trading psychology gets in their way on that path from 0 trades to 100 trades, but you need the entire sample size of 100 trades in order to get this 40R. You have to exploit these trading opportunities over and over, wins and losses. You have to exploit your opportunity as many times as you can, getting up to around 100 before your edge even plays out. So getting this 40R, making a profit, exploiting an edge in trading is absolutely impossible if you can't stick to a strategy through losing trades. And so in order to stick to that strategy, you need a good trading mindset and good trading psychology. Right now, I'll share with you the best ways I have found to improve trading psychology, because again, that is going to be a more important lesson even than the strategy you're using. We're exploiting a tiny edge, and in order to do that, we have to have a good trading mindset. So the ways that I have found to increase trading psychology for myself and for thousands of our students is a 3-tier system. What we do in this 3-tier system is we focus initially on backtesting. Backtesting is the process of finding the strategy you're going to use. For example, if you were using this strategy and it's something you wanted to backtest, you would take the rules that we have set forth through CEST, you would look back through historic data, you would test the last 100 times or more that this specific trading strategy happened. And you would see what was the win rate, what was the average reward to risk I could have gotten, and was it profitable? What you'll see throughout 100 backtested trades is that this strategy had plenty of periods of time when it lost a few trades, and it had plenty of periods of time where it won a few trades. And what happens is, if you see that through historic data, it gives you a better handle on your emotions when you're seeing it happen in live trading. So the first way we work on trading psychology is by backtesting whatever trading strategy it is you are using a sufficient amount of times. After the backtesting process, the next thing we like to focus on is demo trading. And I'm not talking about demo trading randomly, because that gives you absolutely, the only thing that works on is your ability to place trades on your platform, which is something you need to know how to do. But I mean demo trading the proper way with a full trading plan. So once you have a trading strategy using CEST, I like to go through the demo trading process. This isn't something I do anymore, but this is what I teach students to do. Go through the demo trading process for 1 to 3 months using just that strategy, and see it even when trading it with real data on a real candlestick chart, not with a live account yet, but seeing this strategy go in and out of drawdown throughout a 90-day period is something else that will improve your trading psychology and your confidence. And lastly, the way we work on it while you're live trading is by utilizing good risk management. If you're in a position with your life savings, there's absolutely no way you're going to have good trading psychology. If you're risking too much of your money and you lose 3 to 5 trades in a row, there's no way you're going to continue doing that, because you've now risked too much of your hard-earned money, lost too much of it, and you're becoming extremely emotional instead of thinking logically and going, okay, out of 100 trades, I probably still have an edge, even though I just lost 4 trades in a row. So instead of thinking about that from a logical perspective, what tends to happen if we're risking too much in our real trading is we start to think about it from an emotional perspective, when we go, damn, that $500 could have paid my car payment, or that $500 is something I needed to pay my power bill next month. And that's not a place you want to be in terms of trading, especially when you're trading in a live account. So managing your trading psychology comes down to managing your risk management, backtesting whatever strategy you're using, and demo trading for a little bit just to get accustomed to seeing the strategy go in and out of drawdown while you're trading it on a real market and on live candles, not a live account, live candles. So there's a little lesson on trading psychology for the end of the video. If you enjoyed this video, click that like button for me. Go ahead and comment if you made it to the end. Subscribe if you are new, and if you're ready for some more advanced training, we do have some space available in the TTC Forex University. If you want to learn more about that, you can find all the details in the description. It's going to be the top link, or you can just go to www.ttcfxuniversity.com. Hope to see you there. If not, that's completely fine too. Again, just make sure you are subscribed here so you don't miss any of this valuable content we come out with every week. Trade green, and I'll see you in the next video. Talk soon.